Hey, Paulado. Welcome to the live. Javin 1, hi. We start in 3 minutes. Natasha C42 bucks, my 11 DJ. Welcome. Tosi Abiodun. Welcome. Grand Moolah. Player fans. Evans, Kwesiefa. Welcome to the live. We start in about 3 minutes, guys. I'm doing well, thank you. I hope you're doing good too. DC10, welcome to the live. MYs, welcome to the live. Hi, Grand Moolah, I see you. Hi, Tosin. Hope you guys had a wonderful day. Grand Moolah, thank you. I see you. Thank you, Evans. Thanks for the roses. We start in 2 minutes. I'm going to flip the camera around. I thought today I might show you the same stuff we've been talking about, but this is with synthetics. I do not trade synthetics, but I just thought that I would show you guys that actually this stuff works regardless of what you trade. Let's make this clearer. Awesome. Let's see who else is in here. Hey, Patty, I see you. Welcome. Thank you. Tosin, you're very welcome. It is my pleasure to be here. And I'm glad you guys show up too. It means a lot. Because I love to teach. And it's awesome to know you guys want to learn. All right. Give me a quick second. We'll start in a minute. I'm going to pause my live briefly. Okay, let's set this up again. Make sure that's easy to see. Okay, that's better. DND on. Let's make sure my Telegram is off. Awesome. Okay. Hey, Innocent. Welcome to the live. I see your Ray on here. All right, it is 11 o'clock. Good evening, good morning, afternoon, night, time, whatever you are, wherever you are. My name is Nessa, and if you already know who I am, then you already know what this is about. I teach the same thing over and over and over again. Mostly because, and I'm going to flip my camera around while I talk to you, mostly because I believe in repetition. The more I teach you something, the more it sinks in. And then at a certain point in time, your mind is like a sponge. You start to naturally look for the things you should be looking for in your chart. And then it becomes second nature. So if you are already familiar with what we're going to do, you already know what's up. And if you're new here, I advise that you pay attention. So without further ado, let's take a look at the charts today. I am currently looking at, what do you call it? This is the Boom 500. We will get to that after I do the thing that I always do, which is address the core concepts that we'll be talking about. I don't like this. I don't know what's happening with TikTok, but this is not clear. What is happening? Let's see. If I do that, can I trick it? What in the ever-loving fuck, my guys? Give me another minute. Let me pause and see what this is. Just going to switch to my other setup. All right. I was trying something new, but apparently that wasn't working out. I need the charts to be as clear as possible for you. Okay, I like this. Cool. Let us begin. So, as we all know, everything starts from the fact that what you're dealing with is money. Everything you see on your chart right now, all of this price action, this is the Boom 500 index. I don't trade synthetics. I tried to once. That was a long time ago. That's why I have this account. I have not traded synthetics in years. And back when I tried, I was not profitable. But the whole point is, I'm about to show you that everything I'm going to teach you today, it works regardless of the asset you're looking at, okay? You just need to take the basic concept and then look for it, apply it, and you won't have a problem. So it all starts, as you know, with money. Everything you're looking at on your chart here, all of this movement is all about money going up and down and up and down, and that's what it is. However, the question is, how do you take some of this for yourself? So, as a trader, once you have figured out your trend, all right, let me grab my text here, my trusty little text so you can see. Once you have figured out your trend, let's change this to something bold and make it bigger as well, 16, boom. You have to ask yourself three basic questions. Let's drag this further down. Question number one, where is the money coming from? Question number two, where is the money going to? And question number three, is there enough room between these two places for me to take some for myself? These are the three questions that you have to ask every time you come to the charts. If you do not ask these questions, you do not take a trade. If you ask these questions and you cannot find the answers, you do not take a trade. That is the rule. Because if you jump in the middle of any old random place and you have not contextualized your whole reason for being in the trade in the first place, you will be lost. That's why you find yourself changing biases. One time you're short, next thing you're long, next thing you're short, and then you have no idea, back and forth, until you've given away all of your money in little chunks to your broker, who will be more than happy to take it from you. So how do we answer these questions in the first place? It's a simple matter of understanding something called the range. Now, it is not the same thing as a zone. I do not look at it as the same thing as a zone. A zone, from what I understand and from what I've seen, it can be pretty random. You could call it that if you want to. I call it a range. Why? Because of the literal interpretation of the word range. A range is a series of things from one point to another point. It's a very clear thing. So when it comes to trading, what exactly is a range? The range is the difference or the area between two prices. What does this mean? If you have, let me grab my horizontal line here. I'm going to change this to yellow. 1 second. So if you have this line here and this other line here, these represent two prices, right? Zooming in, these represent two prices. Even if the difference between these is just a pip, that is still a range. Even if all you have is like, it's really tight like this, it's still a range. But the problem is, it's too tight of a range for you to actually make some money from. The spread will probably eat most of it, so there's no point in that. That's why when we're asking these questions, this question number 3 is very important. Is there enough room between the two places for you to take some for yourself? So now that we've established that a range is the area between two different price points, we can now ask ourselves the question every time we come into a chart and we've realized, okay, so this is the top of my range and this is the bottom of my range. Is there enough room between here and here? Or slightly above here to slightly below here, or vice versa? Those are the things you need to know. Now, why is that? Why does it matter? Because we're trying to find the money. We're trying to find this thing called liquidity, okay? Liquidity is the same thing as money. So think of liquidity as literally all the action you're seeing on the chart, including the areas where you can expect that there will be stop losses and take profits, okay? So all of these things, they count toward liquidity. You need to be able to find the area where there's like the most concentrated amounts of money so you can take advantage of it. So while I have you here with ranges, what you need to understand is this: when you have a defined range, typically, if the price trades outside of the high, and note, by the way, everything that I'm talking about is not necessarily going to play out 100% of the time. If you're looking for something that plays out 100% of the time, I'm very happy to disappoint you. That does not happen in trading, and anybody who's pushing that to you is probably a beginner who has no idea what they're talking about, or they have nefarious intentions and they're going to take your money. Nothing works all the time. This is just a framework for you to use to understand how you trade. So, with that said, if the market pushes out of this range, let's say like the market's, all of that is trading in here and here. If it pushes out, the odds are, if it's taking the high first, the odds are it will turn back in to come and clear the lows, or at least pull back for a little bit of a retracement, which I'll explain very soon. If the low is being taken first, then you can anticipate that the high is going to be taken next, or at least the market will attempt to take the high. Why do I say attempt? Because sometimes it may not make it all the way over there, which is still not a problem. Now let's talk about a little something that you need to understand about ranges. There are 3 specific price points to keep in mind. I'm going to make this wider so we can keep typing. So we're going to talk about the premium discount array, PDA. In the premium discount array, we have 3 important things to keep in mind. We have equilibrium, which is just a fancy word for balance, and I'll explain that later. We have the premium, and then we have the discount. Okay, so these are 3 portions of a range you must keep in mind, and let's talk about the how and the why of that. So remember, this is your range. I'm going to make this thicker just for the vibes. Where is it? Boom. Not a little bit more. Give me something. Aha. So this is your range over here that we've drawn out, okay? This here. The 50% portion of this range, okay, when you measure from the high or the low to the halfway point, that area is what we call equilibrium, okay? It is called equilibrium because it's another word for balance, because it suggests that there is a balance of buying and selling action in the area. In other words, it's an area where both buyers and sellers agree on the relative price of the asset. So, what your job is as a trader is to exploit one end of the deal for another. You're not interested in the equilibrium section except for stuff like taking profits. And if you ever decide you must trade off of equilibrium, which I don't recommend, if you decide to take a trade off of it, you must be very quick about taking your profits, okay? Because anything can happen. Anything can happen at that point. However, from this point here, this 50% point, which we've called equilibrium, the balance point, above that, from that point above, you have the premium section, premium prices. So think about what the word premium means. Something expensive, costly, high end, high range, okay? So what this means is you want to be a seller anytime the price is within the premium portion of a range. But there is a caveat. You want to be a seller when the price is in the premium portion of a range in the context of a bearish trend, in the context of a downtrend. However, the only time it is okay for you to attempt to sell the premium portion of a range when the trend is actually bullish is when you have ascertained on a higher time frame or a higher range frame, and I'll explain that later, that you are in a retracement. So let me explain what I mean by this. This right now, this is the Boom 500 index, right? And this is a 4-hour chart. I'm not exactly sure how you guys calculate this, those of you who trade indices, but here we go. The point I'm trying to make is, since it's a 4-hour chart, this movement that you see right here is pretty significant. So this was a push down. What did we have here? We had a retracement. This retracement, so what I'm going to do to save my sanity is the last 3 figures in this instrument, I'm going to ignore them. So what we're actually looking at is 114 pips. That's what I'm going to call that, okay? So that's what you have on the 4-hour chart. But if I were to drop to, say, a 1-minute chart, no, bad idea, hold on. If I were to drop to, say, a 15-minute chart and I take something similar from here to here, what I'm seeing is nowhere near any of that. This is just 21. Remember, I'm taking off the last 3 digits. It's just 21. So what's the point I'm trying to make here? If you know for a fact, for instance, this has been pushing downward. So it's been breaking new lows. As it's going down, it's breaking lows, breaking lows. At this point, you should only be thinking about selling. But if you insist on buying, because this is a 4-hour chart, it can give you just enough room for you to take something. But you have to be quick about getting out of the trade, because ultimately this is a higher time frame. The lower time frames always take their orders from the higher time frame. And as you can see here, eventually the market pushed down for even further than this slight retracement to the upside. So that's why I said that's the one time that it's okay for you to sell the premium portion of a range, which is from 50% up, in an uptrend, okay? Or on the flip side, if you have 50% here, from there down, that's your discount. What do you do with discount prices? They induce buys. You want to be a buyer. If you something you've always liked is on sale, it's at a discounted price, what do you want to do? You want to buy it. That's the whole point. So whenever the price is in the discount portion of a range, you want to be a buyer with the proviso that you are in an uptrend. If you are not in an uptrend, you must be certain that on a higher time frame, you are at least you're looking at a retracement on a higher time frame, because what did I say? If there's a retracement on the higher time frame, it may give you just enough to take advantage of. So we've talked about the equilibrium, the balance point, the 50% point. We've talked about the premium prices, and we've talked about the discount prices relative to the range. Now, why is this important? We'll talk about it. We must revisit the concept of liquidity, okay? When you have the range, you can find where the money is. And there's 2 kinds of liquidity. So you have number 1, external range liquidity, which simply means money outside the range. Let me drag this so it's easy to see. Hang on a second. I'm trying to get this balanced. Let's come a little bit closer. Okay. So external range liquidity, money outside the range. And then number 2, internal range liquidity, which is money inside the range. Okay? So we'll talk about it. For money outside the range or external liquidity, we have highs and lows. Okay? It's that straightforward. What highs and lows? We'll talk about those in a bit. For money inside of the range, you have order blocks, fair value gaps. Okay? So let's first revisit the concept of external range liquidity, or money that is outside the range. What range? We're looking at these guys here. This is the top of the range and this is the bottom of the range. So you can imagine that when you are within this range, once the price, what did I say at the start of this? If it's breaking up to the top side first, it's doing so, and this is not 100% of the time, please, people. It's doing so to take money that is up here and then drag that back down. It's breaking out, and then the breakout traders are thinking to themselves, oh yeah, buy, 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 buy. We're ready to go. It's up, up, up. And then what happens? Those people who were selling prematurely, their stops are getting taken out. And then you have people who are buying and they're being induced to buy. What they don't know is eventually the market's going to turn around and then take out their stops as well on the downside, pushing to, at the very least, the equilibrium of the range, which is the 50% area of the range, or all the way to the other end of the range, okay? So same thing, if the market is taking out the lows first, and this is not 100% of the time, people, but when it does that, you can anticipate that it might just be wanting to go back in, give you at least the 50% and maybe cross all the way to the other side. So if you want precision, you don't want to worry too much about it, my advice to you is try to exit at EQ, or that's what I call equilibrium, the balance. Try to exit there ideally. Or if you don't want to exit there, at least move your stop loss to break even, maybe take something off the table and then see how the rest of your trade plays out. So we will be showing you actual examples very soon. Just give me a bit. So when we talk about external range liquidity, the liquidity is sitting where? At the highs, which is you have the range, so just above the high of that range, and then just below the low of that range. One thing I'm going to do is revisit the concept of a range, which I said is basically the distance between two different price points. What is the implication of this definition? It means that each of these candlesticks that you're looking at right now is well within its rights to be defined as a range. Let's delete this one and delete this as well. Each of these is a range. Why is that? Every candlestick has an open, high, low, close. For me, I use the highs and lows to define my ranges. Okay? Each of these is a range. So, in the same vein, there's something I would like to talk about. I've talked about it multiple times before, and that's a swing. So let me type this in here for those of you who are screenshotting and taking notes. A swing is basically the turning point. Excuse me, I'm trying to balance this. Do not fall. How dare you. Turning point in price. What do I mean by the turning point in price? It is the literal point at which the price turns around and heads in the other direction from which it was coming. So you have this over here. Take a look. Let's zoom in closer. The market was pushing up, got to this point here and turned around. This right here is the swing. But to be even more granular about it, the swing is a 3-candle pattern. This is a swing high or a bearish swing, at least a bearish swing in the right context. So please don't sell every swing high you see. It has to make sense. So what is a swing high? It's a 3-candle pattern where the middle candle has the highest high of all the 3 candles. And if you think about the fractal nature of the market, if we take this down to a lower time frame, you will find that it's kind of like a head and shoulders situation. Look at it very carefully. Look at that. Head, shoulders. And what were you taught about that? As a reversal signal. Okay, great. But I'm not saying go and take every single swing once more. You must pair it with the concept of liquidity. And if we zoom out like this, what do we have here? Right here is a swing low, a bullish swing in the right context. What do I mean by that? You have this low here in the middle is the lowest low in all of these 3 candles. Notice how as soon as it forms, the market starts to push this way. Notice how as soon as this forms, the market starts to push down. Now, what did I say a range was? The difference between 2 price points. You can literally use high time frame swings to help you define your trading range. So what's the first method of defining your range? Let me come down here and type that up. I don't think I've ever typed that before. So for those of you who have not taken notes, or rather, you've taken notes before, you want to take this one. So let's come back to the concept of a range. I'm going to put that up here. So ways to define the range. Ways to define your range. Number 1, you can use a single candlestick. Has to be on a high time frame. Now, why does it have to be on a high time frame? Remember, it's important that there's enough room between or within the area of the range for you to take some money for yourself. That's why we're asking question number 3 every time we start trading. All right. That's why we go for a high time frame, because a high time frame is going to have a lot more pips, a lot more price action for you to exploit than a lower time frame candle. So depending on the pair you're trading, a high time frame could be H1, especially if it is a very volatile pair like GBP NZD, GBP CAD, GBP AUD, GBP JPY, Euro Aussie, Euro CAD. Or if it's regular pairs like EUR USD, AUD USD, basically the majors, you can use H4 and up, H4 daily, 3-day, weekly, etc. That is entirely up to you. You may also, if you are a scalper and you have a broker that has wonderful spreads like mine, you can use the 15-minute chart as your high time frame. So all of this is relative. If you want to be in and out quickly, It depends. The point is there has to be enough room for you to take something for yourself between the two different points of the range. So, one way to define your range, I said, use a single candlestick. The second way to define a range is to use swings. Okay? And let me show you that again. I just did that. So what are we looking at here? I said a swing is the turning point in price. So the market created a swing, but not only that, it showed you willingness to push to the upside. Now you have a range over here. Once the market pushes up here and creates another swing, what do you have? That's another turning point. So your low here and your high here, what do you have? You have a range. Let me grab this. All right. So you have this guy here, and then you have this guy up here. And now, voila, you have defined a range. That is one example of defining a range. Okay, let's look at another one. The market was pushing all the way, or rather, let's come to this point here. See this swing? 1, 2, 3. That's a swing low, right? Okay, cool. So let's mark that here. Then eventually the market pushes up. It does create this, but eventually that gets broken. No problem. Like I said, nothing works 100% of the time. But eventually what happens? The market comes and creates this 1, 2, 3 swing high formation. And then not only that, it shows you willingness to push to the downside. Automatically, you have now framed a range. What happens? The market dips just below the 50% portion, the halfway point of the range, and that would have been a great place to drop to a lower time frame and then start looking for reasons to be a buyer. To go where? To the top side of the range. So that's the second way that you can define a range. Coming back to the idea of framing your range, when I say use a candlestick, I wrote it could be a high time frame, or it must be a high time frame. I forgot to add or high range frame. And for that, I will go to a different pair because I'm not sure how this boom indices yet. We'll look at it later, but not right now. I'm trying to get through all of this so I can start showing you actual examples on the chart. So let me look at let's see, what do we have? What do we have here? Let's take a look at Euro USD. Awesome sauce. And I'm just gonna drag all of that over here. Great. So what we're talking about, yeah. When I say high range frame, what do I mean? What I mean is very simply this. If you're looking at this is a 1 hour chart for the Euro USD, okay? That's all great and everything, but then you have the option of using a Renko bar chart, which is RENKO, or a range bar chart. The thing about these charts is that they do not care about time. So let me open the first kind, which is a Renko bar. I'm going to go for, let me do, Euro USD. Let's do the 10 pip range bar chart, Renko bar chart rather. So what you're looking at is called a Renko chart. Now, at first glance, you may be thinking to yourself, holy shit, they said there's no holy grail. This is the holy grail. Calm down, hold your horses. It's not necessarily. Because, let me explain how this works. So over here, notice the market's been pushing down steadily. I need you to understand that just because this bar closed here and then this one opens does not mean the market immediately went down from that price. If you think you're going to have zero drawdown trades because you're using a Renko bar chart, nah, you're very wrong. Because it does not show the fact that there may have been some sort of retracement up here. Why is it not showing you that? Because the market may not have moved up to 10 pips. And even if it does move up to 10 pips, it would need an extra 10 pips in order to create a white bar, which is what happens here. So the market pushes down here. For all we know, it may have created a little bit of movement to the downside. Who knows, maybe for almost 9 pips before turning back around, right? Look at this area here. There was definitely price action. And then you finally get this candle here. Boom. Do not assume that this low was clean and do not assume that the highs are clean. Okay? It's just that the Renko bar chart focuses on giving you the opens and the closes, and it does so based on price. In other words, if it takes the market 5 hours to move only 10 pips, then you will not get a new brick until those 5 hours have elapsed. It doesn't matter. If it takes 5 hours for this brick to form, it will take 5 hours. The good thing about the Renko bar chart is that it cleans up the price action. So let me show you the difference really quickly. I'm going to mark out this area. And let me change that to something transparent. Give me a second. Here we go. Awesome. So look at that. And now let me go to maybe like the 15-minute. And you notice we have some of this stuff here, right? You can't really compare it. Or if we look at this, let me take us here. I'm going to reduce the size of this. I want you to look at that tiny little consolidation sideways moving thing here. Right, let's mark it out. And now what I'm going to do is just center it for you to see. Okay, let's see how wide is this range. Okay, cool. So what I will do is take us back to the 10 pip Renko bar chart. And look at that. All of that stuff that we saw on that 15-minute chart, that's it right here. Isn't that lovely? So clean. We know exactly what it is we need to do, or at least I'll show you what it is we need to do. So when I say that, remember, we're looking for the range. We're looking to define the range. Why are we trying to define the range? Because we know that at the highs and lows, we can find external range liquidity. Now, the second thing that I wanted to talk about is internal range liquidity. What does that mean? It's simply money that is within a range. So if I mark this range from here to here, or since we had this turning point here, if I say, okay, I'm going to extend the range to this point, the whole thing is when this bar closes, now I'm looking for a reason inside of here to join in and get in on the move that is to come. Okay? I stress using a high range frame. This is a Renko, the 10 pip Renko bar chart, which means each of these bricks is worth 10 pips. Ideally, I would push a little bit higher because I want really clean movement, okay? So this is a Renko bar chart. Now let me take you over to the second kind of range, which is literally called a range bar chart. Where are we? What am I going to do? Let's use 20. You have to give it a bit to populate. And now this is that same area. This kind of chart is called a range bar chart. Notice how it is also cleaner, maybe not as clean as the Renko, but cleaner than that regular M15 price action that we were taking a look at earlier, if you remember that one. So why or how does this work? It's simple. When the market creates a low point, so let's take a look at this here. This candle closed. That's the close price, right? It closed down. Then this guy opened with a little bit of a gap down. It pushed down and created this low. So from that low point, if the market actually plans to go up, it's going to have to push by 20 pips because this is a 20 pip range bar chart. It has to push by 20 pips before this new bar forms. And then another one opens, it pulls back a little bit, forms that low, and then pushes on up to create that. If this bar had opened and then pushed high and then turned around and pushed back down, that would be your bearish bar. So it's basically you're measuring from the highs and lows to get your 20 pips. There are multiple settings you could use, up to you. You want to use 20, you want to use 50, that's entirely your decision, your prerogative. The reason I love range bar charts is not just because they only move based on price, which makes things cleaner. It's because I've noticed certain things. Certain things like, for instance, if I wanted to get a possible signal, okay? When I say possible, I am very deliberate about this because especially newbies, you come to trading and you're expecting certainty, perfection. It does not exist. And I would like to dissuade you of that notion immediately. I'm going to break your heart right away. It does not exist. I need you to accept that. You do not need to win every trade to be a winning trader. You just need to win enough times. Today, I took about 4 or 5 losses. That was on me. They shouldn't have happened but the reason they happened was because I was looking for tight entries. And eventually it did pay out for me. I took a few of those. My risk each time was 0.1%. And I was able to make back 1.5% total profit for the day. Actually pretty much 1.6. So I'm trying to tell you, you do not need to win every trade to be a winning trader. And if you think 1.6 is too small or something to sneeze at, I want you to ask yourself how much 1.6 of 100K or a million is, and then you start to get proper perspective on trading. So once more, you don't need to always get it right. You just need to get it right enough times, okay? So one of the things that I've noticed about the range bar chart, what did I say? We talked about swings before. Pay attention. Notice how, when you have a 1, 2, 3 swing here, notice how clear that is. One of the things I've noticed about range bar charts, especially if you're using the trend, you're working with the trend, is once you have that 1, 2, 3, especially when these two candles look like this, Okay, this length of body and this length of wick, a balance between the bodies and the wicks. What do I mean by that? So like almost 50% body, 50% wick type of thing. What tends to happen? The market will at least give you one more move for the same number of pips that each bar is worth. So do with that information what you will. And it's not a one-off. Look at it here again. We have 1, 2. So this one's a little bit different because there's more wick than body, but still 1, 2, there's one more push. 1, 2, this one failed, but no problem. The point is it happens enough times, 1, 2, for you to take advantage of it. Look at it here again. Where are we? 1, 2. In this particular case, what happened? The market retraced, which is fine. It did not break the swing. So you could have used this as a beautiful entry for very little drawdown to push down. 1, 2 again, the market pulls back, drop. That's why I personally love the range bar charts. So let's move back to what we're talking about. We have to talk about, now that you know how to find liquidity, okay? So you know it has to be on a high time frame or a high range frame, and that you know you can use swings as well. The same thing applies even here if you want to use swings to frame your trades. So let's see what we have here. You have this swing low here that forms. The market pushes up. It creates this swing, but instead it breaks it. Doesn't matter, because what did I say? You don't need the thing to happen all the time. You just need to happen enough times to be able to exploit it. Creates this swing here that doesn't work out. Then it gives you this swing, begins to push down with willingness. Once you see that, you can very easily mark this low and this high. If you don't like that, no problem. You can mark an individual candle's low and high. So I'm going to do this. Over here, this candle's low, this candle is high. And then I could say to myself, okay, I see that we've been pushing to the top side. I'm looking to continue this, and I'm wondering if this is going to give me a continuation thing, because we don't know yet. All of this shit hasn't happened, right? We don't know. So I could go to a lower time frame and ask myself, what is the liquidity inside of here that I could have used to join the trade? So that's what we're going to answer. That's the question we're going to answer. I'm dropping a vertical line here so we know exactly what it is we're looking at. I think I'm going to go ahead and box this as well so there's no confusion. So remember, this box is that 20 pip range on Euro USD. So I'm going to drop down now to a 5-minute chart. On a 5-minute chart, beautiful. This particular point here is exactly when that 20 pip range bar chart was formed. So remember, we're talking about internal range liquidity. And now I'm about to show you two kinds of it. The first kind is called an order block. What is an order block? Let me zoom in. For an order block, what you're waiting for in the case of a bullish order block is you have a high, 1, 2, 3. The high gets broken. When that high gets broken, the last bearish candle that was responsible for the move, that sponsored the move that broke that high, that is your order block. If you find that the candle before it is also bearish, you can mark that as your order block as well. Give me a second while I lock all of these things in. I don't want to lose my place. All right, so let me draw that for you so you can see it very clearly on the chart. So you guys know me, you guys who've been here, you already know that typically I say that when it comes to order blocks, if it looks like a doji type situation, I hate it, I don't like to touch it. But remember, in this context, we're working with a 20 pip range. 20 pips is not a lot, okay? So in this case, it's something acceptable to take because you're already pretty much about to take off from here. Think about it. You have this, and all you need to see is the market going to retrace into something? So once this is formed, why I like range bar charts is your life is simple now. All you're looking for is from this point here to the back here, and that's it. You have no business scrolling all the way back to 2,000 years ago when our good Lord was born to find the order block that he and Mary may have invested in. No, you can just focus on this area here. That's what I love about the range bar charts. It doesn't matter if it's a 50 pip, whatever it is you're doing, when it's formed, you're just looking, you're asking yourself, okay, I'm going to set an alert at the 50% level. And then when it's hit, what I'm going to do is ask myself, what is it within the 50% I could use as an excuse to get in with the trade? So this is a bullish order block over here. Once more, you have a high gets broken. The high gets broken, then we wait. What do you see? This becomes an order block. You could mark this or you could mark the two of them. In this case, doesn't matter. Some people will use the entire wicks. Some people will use just the body. Okay? So that's up to you to figure out what you prefer. In this particular case, what happens? The market retraces into this order block here, respects it beautifully, and takes right off. So you could have your entry right at the order block as a pending entry with your stop loss at the low. So this would be for about 7 pips. And then you could know that at the very least, if you're a scalper, that's a 1-to-1, or at the very least, you could target this high here. Or you could simply observe the trade because remember, you got this based on a 20 pip range bar chart. Let me load it up again, which is here. So you could just hold on from that point and be like, you know what? I'm feeling pretty adventurous today. Let's see how far this is going to go. Or even better yet, you can pair this along with regular time frame analysis. In other words, let me take you to the weekly and let's start from there. A trade I took today, the first thing I noted was the fact that this is a weekly chart for Euro USD, EUR USD. 1, 2, 3, that's a swing high. This candle breaks above it. This candle also closes. And now I'm going to show you the second kind of internal range liquidity. Give me a moment while I draw this out for you to see. And then change it to something transparent. One moment. Yeah, that's fine. What is a fair value gap? Let me explain. So the first thing you're looking for in a bullish context, if it's a bullish fair value gap, is you're waiting for a high to get broken. This is a weekly chart. It's a significant chart. There's many pips in this candle here. So if the break in this case was only a wick and not this full body, just something to keep in mind, I would consider a wick as a break. Okay, but that's not the case here. There's just something to keep in mind. So in this case, what happens? We have a high. This is broken fully with a strong close. Then you wait for the next candle to see what it does. And what it does is it closes, and then you're measuring from the low of this candle here to the high of this candle here. To see something, what you're looking for is this high, this candle, this wick, it does not trade through this space here. This low, it does not trade through the space here. So remember, all of this other stuff does not exist. So this area from this wick here to this wick here, okay, remember, you're waiting for a break and then the next candle to close. This area here is a gap where there's nothing but bullish body. There's nothing but buying. It is an imbalance. The sellers did not get a chance to do their thing. And so the market has to, well, it doesn't have to because it will do what it wants to do. But the point is there's a high chance it will come back and then balance this imbalance, by which I mean it will retrace into that. And once it retraces into that, it'll give you your opportunity to be a buyer. If you remember what I was saying before, see this here? What is this? As soon as this break happens, it is also an order block. So I'm going to use a different color so there's no confusion. I generally don't like when an order block is a doji candle like this, but because this is a weekly chart, I'll take it. So let's change this to a different color and then make that transparent. Cool. So this here, that's an order block. And why am I pointing this out? Listen, if you find an order block that is followed by a fair value gap, that fair value gap is telling you this order block, you can trust it. It is most likely going to play out. It's a high probability order block. And what happened? The market retraced not just into the fair value gap, but the order block as well. And notice this price action here, this wickage. Please do not send me invites. Notice this price action here. Notice the way the market taps into it and then rejects. What is a wick? A wick is giving you a story. It's a very powerful thing. Observe the story that this candle is telling you. So it opened here, it pushed up, it pushed down, and it looked like, at one point, it looked like a strong bearish candle. You may have been convinced that, yeah, this is going to be a sell. For those of you who don't wait for a candle to close before you take action. But then what? The market pushes back up like this. And it's not pushing up for no reason. It is pushing up based off of this order block here. So that's a strong signal to you to look at this week as a bullish week. Okay? So we've talked about the order block and the fair value gap in the bullish context. Let's talk about it in a bearish context, and then I'll come back to the Euro USD chart, show you what I did. First, let's go to USD CAD. because that's the most recent one, bearish one I know. I'll take you to the weekly chart. Is it USD CAD? No, my darling, it's USD CHF. Let's fix that. USDC dollar Swiss. So, oh, that's beautiful. How did I not see this? Ooh, that is so beautiful. Okay, so let me show you what we're talking about in a bearish context. First things first, let's talk about a bearish order block. There we go. Come on now. I guess they don't have, okay, yeah, that's enough data. Boom, bam. So let's take a look at this guy. Right click, change the color, make it white and see-through. Awesome sauce. What do we have here? Zooming in. First things first, you have this low. This low gets broken. Okay? Broken with these series of candles here. As soon as this happens, this last bullish candle that led to the move that broke the low is your order block. Now you're looking to the left and noticing these candles are also bullish, and they're consecutive candles. Consecutive meaning one after another. Doesn't like there's a bullish one, a bearish one, etc. They're all together. So what you can do is just go ahead and highlight all of that. So when the market pushes down, it eventually retraces into this order block. And what does it do? This is a weekly chart, mind you. It pushes in and it starts to leave those wicks, because at one point this was a very strong bullish looking candle, and then it flipped back down one more time again. And what do you have here? If you've been paying attention, what is this? 1, 2, 3 swing formation. What is it I've been saying? You've probably seen one of my TikToks where I said if you pair liquidity with higher time frame swings, you will have accurate trades, or much better accuracy, and you'll have trades that pay you handsomely. So if you had seen this here, such an excellent setup, you could have taken that and you could have held that shit for how long? Let's see. So this is a low, right? And your entry would have been somewhere maybe in and around here. You could have targeted this low. Let's say, so from here to here, that's about 120 pips. That's impressive. That's something. And if you go to a low time frame, you refine your entries, that's pretty impressive. Maybe you had a 20 pip stop loss or a 10 pip stop loss and you were able to collect all of that. That's impressive, guys. If you have always felt to yourself the money's on the lower time frame, I promise you it's on the higher ones. Actually pause and wait. I know it's not sexy. I know it's hard to wait. I know that you'd want to make your money quickly. Like when I first got into trading, I really thought that, oh, the 1 minute chart is where it's at because I'm going to make the money really quickly. But no, again, all of the higher time frames are the ones that dictate what happens on the lower time frame. So what looks to you like a trend on a low time frame may just be a small retracement on the higher time frame. So imagine you're somewhere in here and you're thinking to yourself, oh wow, it's an excellent buy trade, which is fine if you're a scalper or something. But then price gets to this point and suddenly it zips on you like, what is happening? You know those monster moves that you see during the news or just randomly out of nowhere? It's because it's responding to something on a high time frame, but you didn't see it. So always start your analysis from the monthly. Even if it's not sexy, I promise you, you will start to fall in love with it. And you will fall in love with the process of just sitting on your hands and not doing anything until the price gets where you want it to go. Right. So having said that, that is a bearish order block. Let me show you an example of a bearish fair value gap. This is a different kind. I like it. So almost the same thing. Don't be confused. What do we have here? This is broken. As soon as this is broken, look back, you already have a fair value gap here. You could wait for this guy too, but it doesn't matter because if you're going to trade this, my advice to you is to always, whenever you see two fair value gaps, make sure you take the first one. If you're taking the second one, make sure your stop loss is wide enough so that if the market wants to dip into that first one, it doesn't take you out, okay? So let me show you the fair value gap here. We have this low, it gets broken. This is that gap here. This is one. Remember, let me zoom in so you can see this. This wick did not trade through here. This wick did not trade through here. All you have is just pure selling. The market at some point comes here to mitigate that, to take some of that, to balance that, even though it doesn't go all the way through sometimes. But it does its thing, though. It pulls back into here. And this is another thing that I want to tell you guys I don't think I've said in previous lives before. This is how you find your draw on liquidity. What is that draw? The word draw on liquidity is just basically the magnet for price. What is pulling it? You know, like a magnet draws something close to it, basically. So look at this situation, and I'm teaching you how to think for yourself. Look at this situation here. You've pushed down, and then you have a 1, 2, 3 swing. What did we say about swings? That they are significant. And what is this? This is a swing low on a weekly time frame. And notice that this swing is not random. The swing is responding off of this here. What is this? Break in market structure, immediate order block. Taps into it beautifully and then pushes up. And by this week here, this week's close, you have an official swing, which tells you, okay, so if we're coming from here, we've made the swing, we're coming from this low here, where might we be going to? Fair value gap, and we head right into it. So you could have taken this as well for a few pips. Then as soon as you tap into it, what happens? The market's turning around now. It's made a 1, 2, 3. This is a swing. Okay, now that we have a swing, we know a swing is a turning point in price. Not only is this a swing, it's not a random swing. It's a swing that is coming from an area of liquidity, internal range liquidity. Why is it internal? Because this is the high and this is the low. Okay, this is another swing here, and the market started pushing down. So it's another swing here. So this area, what do you have? This is the premium portion of this. Let me mark it out so it's not like I'm just talking. Where's my rectangle? Come here. Here to here. Right click, change that color. I'm going to change that to white. I think it's going to be better. Yeah, so look at that. This is the high. You know it's the high because the swing forms and then it continues pushing. This is a low. How do you know it's a low? Because the market came here really rejected, and the rejection was based off of this order block. And not only that, then you finally had your 1, 2, 3 swing. Now, where are we? 50%. Above 50% premium. What is above 50%? This here. This fair value gap. Market taps into it. Or you're still feeling unsure for whatever reason, no problem. 1, 2, 3, this is a swing formation, rejecting this. Now that it has formed that swing and you know what is the definition of the swing, the turning point in price, we are now going to do what? We're going to target this next area here. The reason I do not teach any other kind of liquidity besides order blocks and fair value gaps is this. Some of you, like me, in the past, you learn everything, you learn too much, and you get distracted. And then you're seeing too much on the charts, and now you're paralyzed because you have no idea what to do. I have long since learned, and these concepts, by the way, disclaimer, they are not my concepts. They are by the inner circle trader Michael Huddleston. Some people say that it's not his concepts either. He took it from somewhere else and renamed it. I don't know the man. I don't care about that story. I care about whether what he's teaching works or not. And I have used it, and I see that it actually does. So if you are familiar with ICT, the reason I raise it is he teaches so many things because he understands the price deeply, which is great. But if you are just starting off or you are struggling and you've been at this for a while, you do not need too much information because too much information clutters your brain. Next thing you know, you're seeing an inverse FVG and this other FVG and that are in balance. And now you're like, no, okay, so now what do I do? Reduce it to just two things. And if you can, just pick one thing. That's my thing anyway. So you have a 1, 2, 3 swing. What's the next logical area for it to target? Well, if this is a swing here and this is a swing, we now have a range. What can you target? If you're trading from internal liquidity, you can take your profits at external liquidity. Or at least you can move your stop loss to break even, take something off the table and wait and see what happens. If the market's willing to continue to give you an extra push, because after all, this is a weekly fair value gap. So it's not unreasonable to expect quite a bit of movement. Where can you take profits? You start looking left because you notice you now have a larger range, which is from this point here. Are you guys understanding? Because I have not done this before. Those of you who are familiar, I have not done this where I'm like showing you multiple ranges within ranges and ranges outside of ranges. So by the time you are in this trade and you've pushed down, we've taken this low, you're asking yourself, where might you exit? What do you notice? The market turned around here. The market also turned around here. You have a range. Where's 50% of that guy? Somewhere around here. What's just beneath that? What is just beneath it? Okay, look here. What do we have? What do we have here? This is a high that got broken. What is this? A fair value gap. You can use that as an exit as well. Don't want to use it? This is an order block. For those of you that use the body. If you don't want to use it as a full exit, take something off the table and adjust your stop loss again and keep watching to see if it's going to take you to the other side. It does not, as you can see. It only makes it like to the really discounted portion of the range before it starts to turn around again. This is how you work with ranges. This is how you know where you should be getting into a trade. This is how you know if your signal provider is full of shit. Okay, give me a second, guys. TikTok is asking me to prove that there's activity going on here. So I have to slide this thing. There we go. Boom. And that's sorted. So here's another more recent example, fair value gap. What happened? And it's not a signal, but try to think about where this guy is going. What do you have here? This is a low. The low gets broken by this candle. When this next candle closes, what do you have? Fair value gap. I'm going to mark that out for you. Boom. And boom. Okay? What you notice here, the market has retraced into this fair value gap like so. And what is it doing right now? This candle hasn't closed. This is a weekly bar, mind you. This is the present week. It hasn't closed. But what is it doing? What should you be thinking about doing with your day? Let's drop down to the daily chart and see how that played out. Yesterday, this is yesterday's bar. Notice when the market traded up into this fair value gap from the weekly, what do we have here? 1, 2, 3, swing formation. If you are not sure about how to get in on this, when you see this guy, that should automatically tell you start looking for sells. Okay? Going down to a much lower time frame, let's see all the opportunities you could have had. Hang on a second. This is a 4-hour chart now. I took this last week. It was such a beautiful trade. But remember, we're talking about ranges. Did you know your fair value gap as well is a range? Because it is. It's literally, what did I say a range is? The difference between two price points, the area between two price points. So what is here? Once you have the market trading into this, you can have a simple thing of, I'm going to look at 50% here. I'll set an alert and then I'll go to a low time frame and see if I can get a break in market structure to the downside. Option 1. Option 2, I'm looking at 50% here. What's just above 50%? Sliding over here, what do we see? Aha. Here, and this low gets broken. Once it gets broken, what are these 3 consecutive candles? Order block. So I'm just going to go ahead and mark that so you can see. Marking the high and the low, dragging that back. What happens eventually? The market taps into it. This was such a beautiful trade. If I go to a lower time frame, I can show you how it played out. It came back up into it again. Remember, this is a weekly order fair value gap that we're trading based on. So this 4-hour order block is within the weekly fair value gap, within the premium portion of the weekly fair value gap. What do you have here? 1, 2, 3. It's not obvious, and it kind of looks like, if you're not experienced, you may be thinking to yourself, oh, this is going to be a buy, especially if you did not look at the higher time frames. Maybe you stopped at H4. Those of you that only use H4, try to look at the monthly, the weekly. I promise you, those are worth it. Monthly, weekly, daily. I love the 3-day chart as well. It can give you some really beautiful setups. Check those out, right? So you have this refinement here. So if you wanted to, 1, 2, 3, you have this, you have your stop above here or just above the range. That's up to you. What happens? The market drops for almost 120 something pips. You don't like that? No problem. Let's talk about refinement. So I'm going to set this line here so I know where we're going. I'll take you to the 15-minute chart. What happened here on this day? Very simple. This is that area we're interested in. Hang on, let me bring this down. Why would we be willing, when we see this 1, 2, 3 swing formation, why would we be willing to take it? It's not a random swing. It is a swing that is hinged upon a 4-hour order block, which is hinged upon a weekly fair value gap. You start to see how your argument for a trade stacks up. Okay, you don't want to get in here and have a stop loss of 8 pips or whatever. Okay, fine. Let's go see what happened on the 1-minute chart. I crave your indulgence, please, while I scroll. Here we are. This is that 1 minute here. So all you're doing is waiting. Waiting for what? Market keeps pushing, making highs, making highs. Eventually we have what? The swing low here that gets broken. What is this? This is now, shit, I'm just noticing you guys can't see it. Yeah. This is broken. This is now an order block. Actually, now that I'm looking even closer, excuse me, need my cursor. Where is, come here, my friend. What is this? 1, 2, 3. It's a swing low that gets broken. As soon as it gets broken, this next bar closes. Now what do you have? This is a fair value gap. What did we say about fair value gaps and order blocks? The fair value gap validating this order block and telling you that it's powerful. What happens? The market trades right up into it almost perfectly. What could you have done? Entry here, stop loss either at this candle or at the very high for about what? If it was here, it'd be 1.3 pips. If it was here, it'd be about 3 pips. And then the market gives you all of this. That's ridiculous. Let me measure from the top. You can't see the top here, but this goes all the way down to about 108 pips. Okay? This is how you use these. If you did not like that, no problem. You could have waited and you'd have found, allow me to delete this, please, it's getting in the way. You could have waited. You have this low here. This low gets broken. Immediately it's broken. What is this now? This is an order block. What happens? The market retraces into it. What's the high of this order block is also a swing high. As it turns out, the market never ever pushed back into it again. This is that candle here. And then drop. And all of this from a weekly. That's why, this is what explains these monster moves, why it is that the market is dropping 50, 40 pips in just 5 minutes. Because you're using the high time frame. Because you're pairing high time frame liquidity with swings. This is how you present arguments for your trade and know, okay, if this is going to work out or not. And this is how you also know when to get the hell out. Like if I was in this, for instance, this particular trade here, this current one, I would be looking to get out at this low, assuming I'm holding that long. I prefer to just be done for the day. I would prefer to just be done for today. So let's look at this example. And remember I said that a single candlestick can also serve as a range. So let's look at this example. You don't need to use a Renko chart. You don't need to use a range bar chart. Let me show you this. 1, 2, 3 swing, right? Okay, cool. The swing is formed. So what I'm going to do is what? Mark the high and the low. Now, take notes. I need you to decide right now. Are you an internal to external range, internal liquidity to external liquidity trader? Or are you an external liquidity to internal liquidity trader? And what do I mean by that? You already know external liquidity rests where? At the highs and the lows. So if you're an external liquidity trader, you would be waiting to see if there's some sort of push to the top side for you to take and exploit that to the downside. In this case, since we know that we're bearish. If you're an internal to external liquidity trader, you're looking for something inside the range to target something outside the range. Now, can you do both of these things? Absolutely, with time, with practice, with experience. But let me tell you something, as someone who has time and practice and experience, I have still found that it's just much better to stick to one thing. Don't scatter your energy about. Pick one thing, pick one pair, pick one entry criteria, pick one exit criteria, and just simplify your life and you don't have to worry too much. I promise you. Forget being taught so many different approaches to the chart. That shit will confuse you. Keep it simple. Keep it simple, and then I dare you to remain unprofitable. It's impossible. Will you have losing trades? I'm not saying you will never lose. Do not get me wrong. I am not saying you will never lose. You will never catch me tell you that I have a holy grail, that you will never. No. What I am saying is over time, in the long run, your cumulative results, ain't no way you will not be making money. Just pick one thing. And also keep in mind, you don't have to take every setup. You don't have to be there every day. Just because the markets are open 7 days a week, depending on what you're trading, or 5 days a week, doesn't mean you have to show up. Sometimes we forget the whole point of this thing is to be free. You're not trying to trade your 9 to 5 for a fucking 24-hour job shackled to your laptop. You can't see it, but there's like invisible handcuffs holding you to your laptop. That's not the point. Let's not forget. It's freedom. So let's talk about this. 1, 2, 3. This is a daily chart USD right? And I've marked the high and the low of this third candle. And by the way, something I want to say about swings, I've said it multiple times before. If it's a valid swing, normally that third candle, it's high, in this case, since it's a swing high, it will not get broken. If it does get broken, I start telling myself, if it passes the high, definitely probably invalid. Unless I see a reason that this may be, just some sort of turtle soup trade. Same thing with a swing low. If a swing low is valid, that third candle is not going to get broken. Not all the time, but enough times. Keep that in mind. This is an example here. 1, 2, 3, swing high. This one got broken, but it did not take this out. So if you got taken out here, don't be in a hurry to say the trade was invalid. Wait and see if you'll get another setup. But typically, when you get that swing, that third candle can be all you need. So anyway, this is a daily chart. I've marked the high and the low. Let's go down to a lower time frame and see what would have presented to us as an opportunity. So this day, and now I'm going to delete it so that I can show you and move my cursor around freely. This right here, all of this, is that day that's completed. So now all we're looking for is reasons to sell. So if I'm marking, what do we have here? This is the high of the day and the low. Let me just grab that. I guess I have to. Just briefly, I'll change the color. This is the high and the low. What do we have here? This is Sunday into Monday. Okay, this is Sunday, Monday. This is an entire day's range. What do we have? 50% of the range is what? Equilibrium. What's above equilibrium, guys? Premium. What do we want to do with the premium? We want to sell. So all I'm looking for within this range is I'm looking from this middle part here, and then I'm looking to the left. What is within the premium section here? Thing number one that I can see, we have this low, it gets broken. What do we have here? This is an order block, 1, 2, 3 series. If it's not clear, no problem. Eventually, the market will give you something. Let's take a closer look. Let's take a much closer look. This is a low. Low gets broken. Low gets broken. What is this? Order block. The market retraces into it. Tap. Beautifully. Perfectly. This is the reason some people just use the bodies. In this case, it came to the body beautifully. Your stop loss could have been at this high or this high, and it wouldn't matter. The point is you get pips, and then it starts to break down over the course of the next couple of days. If you don't like that, no problem. Remember when I said that you could be an external to internal range liquidity trader? Okay, so what I'm going to do is I'm going to delete this box. Remember, what is this? A swing. Then the market starts to push down. Then you have another swing here and the market starts to push up. As soon as the market starts to push up, what has this done for you? It has created a range. Changing the color. This is a range, guys. Showing you multiple ways to create your ranges. So I don't think I listed everything. My bad. But the recording of this will be available on my YouTube channel. The link is in my bio. So if you are an external to internal range liquidity trader, this is you. This is your setup right here. A range has been created. So all you're doing is waiting to see a high get taken, and automatically, because you have that range, you know exactly where your exit is going to be if you just want to be in for a short period of time. Because the less time you spend in the markets, the less you have to deal with. Shit like pullbacks, suddenly the market going against you, or stuff like Donald Trump tweeting about his left nutsack. I don't know, whatever. So my bad, guys. So let's go to, oh dear. Give me a second. I have to change this template back to There we go. So here we are. This is a 15-minute chart. What I'm going to do is take you down to the 1-minute chart to see how you could have gotten in to that particular trade. Patience with me. This is that range here. Okay? Because you are basing this on the concept of liquidity, it is possible for you to know that this 1, 2, 3 swing formation is more than enough reason to get into that sell, like without waiting for a break in market structure or anything. Because remember, all of this started from the weekly chart. We started with a weekly FVG, worked our way down to the 4-hour. So we have the backing of the higher powers, guys. The higher time frame is saying, whatever the hell you do, it sells. So that 15-minute high that we marked was not random. It was based on the fact that we have gotten our bias, our directional bias, from identifying liquidity on a high time frame. So this could have been an entry. You don't like that? You want more certainty? No problem. Let's take a look. This is a low, then this is a higher low that gets broken, and then this bar forms. Once this bar forms, what do you have here? Fair value gap. Look at this guy. Taps into it, just a tiny little kiss, leaves behind that wick. You could have entered, had a pending order here with your stop above there, and then you wait and see what happens. Don't like that? No problem. Here is a low. This candle breaks it. When this candle breaks it, this is now an order block. Two consecutive bullish candles. Market retrades into it. Your stop could have been here for 0.7 pip. That's ridiculous. So let's just say 1 pip, and then boom. When you are able to identify where the money is coming from, guys, remember, I didn't start this randomly. I said, when you are able to identify where the money is coming from and where the money is going to, which is what? We're talking about that range. Once you're able to identify that, it does not matter if you get taken out of the trade. You still know where it's going, so you can get in again. And that's why when I lost multiple times on Euro USD today, let's go to the 15-minute chart so I can show you. My entry was here. I still have my markings on. Let me make this clearer. I'm going to change the color. Excuse me. All right, cool bet. And I think I'm going to leave that one. Let's zoom in. Why? I didn't even need to get stopped out, to be honest. I just wanted a really tight entry. So what happens here? This is a high. The high gets broken. Boom. When the high gets broken, then this next bar, it closes up here, leaving behind what? This fair value gap right here. Let me grab this. Oh, shit. I need to get that out of the way. Delete. Okay. Leaving behind this fair value gap here. Okay. So even if I was trying to be a crazy person and I was looking for, now I'm going to the 1 minute chart. That was the 15-minute. I was looking for, this is where we traded into, right? I was using like a much lower whatever to try to figure my shit out. So let's say I came into this here, 1, 2, 3, and then I had my stop here. Then what happened? Once this closed down, it took me out. Okay, fine, no problem. I can get in again as soon as I see another swing. Why can I do that? Because I'm certain of where we're going. And no, I didn't just use the 15-minute chart, mind you, for those of you who are wondering. I started from the weekly. This is the weekly chart for EUR-USD. We had a break in structure to the upside and the fair value gap was created. The market retraced into it. My anticipation was we're going to push up and we're probably going to take that high. It's not a signal. Please do not take this as a signal. If you do, you are completely responsible for your trades. I do not babysit. I do not feed signals. I want you to be able to think for yourself. So that's what I saw on the weekly. Jumping down to the daily chart, what did I see? I saw this 1, 2, 3 swing low, rejecting this fair value gap over here. And not only that, this candle here indicated to me a willingness to push to the upside. I'm looking at this high. I'm looking at this high as possible areas to take liquidity and probably even further up. That's why I had the balls to set. Once this 15 minutes fair value gap happened, even if I got stopped out a couple of times, two things are going on. I need you to understand my thought process as to how and why I did not care that I kept losing. Number one, my risk was 0.1%. Some of you are not ready to hear that. Some of you are that's not Lambo money. That's fine. It is Lambo money if you have enough funding. Try to keep that in mind. 0.1%, I'm not flinching. That's why I can enter a trade and not be emotional about it. I can be completely neutral and I can focus on the process of trading rather than being distracted by, oh my God, shit, I put too much risk on. Thing number two, remember, I'm working with high time frame liquidity. This 15-minute fair value gap is not random. It is based on the fact that I have come from the weekly, come down to the daily and the 4-hour chart. I've observed the price action there as well. Because at the time, where were we with this? At the time, I saw this. And I was like, yeah, okay, it's just giving. This is fair value gap. This is all these wicks here. The market has not been able to push significantly beyond here. So to the downside. So maybe, just maybe, I should be looking to be a buyer. So what am I saying once more? The point I'm making is when you know where the money's coming from, money being liquidity, and when you know where the money's going to, and when you know there is enough room for you to have some for yourself, you are no longer scared of losing a trade. You understand if you lose a trade, it's probably because maybe you had a too tight stop loss, or maybe you were just a little early to the party and all you have to do is wait. But you will get your entry and you will get your exit. All right? So I'm pretty sure that's been helpful. What else is there to say? What am I missing? Yes, I promised that I would. Let me clear all of this. We're looking at the boom indices today. I do not trade synthetics, but I wanted to show you that this is basically the same thing. What do we have? This is a low. The low has been broken. This is a H4 time frame, mind you. Let me pull up my rectangle over here. Change the color. Change the color, make it white. Darn it. Come here. Transparent, thank you. What do we have here? Fair value gap. Okay. For value gap. Fair value gap H4. 4-hourly chart. Okay, let's go down to maybe like the 5-minute and see what happened there. No, go back up. I need to make sure we have our line. And then I'm gonna go gradually down. Let's go to the 30. Shit. Anyway, y'all know it's somewhere around here. So now what? Now let me just do the right thing, bro. Straighten it properly, and then I'm gonna lock it in place so it doesn't move again. Lock. Great. Lower time frame, what has happened? The market trades into it. It's traded into it because you know it's a fair value gap. You're seeing a swing here. 1, 2, 3. What is that swing based off of? Look to the left. This is a fair value gap as well. The market created this low, broke it. Once it broke it, this became an order block, pushed further down, then it left behind this fair value gap, further validating this order block. The market came right into it and pushed off. And this is not a one-off. Okay, let's see how we might have taken advantage of that on a, which is kind of tricky because there's all this, you guys who trade, boom. I don't know, man. This is that area here. So maybe you're just waiting for this low, and then the market pulls back down. You have this low. Once this gets broken, you treat this block here as an order block. What happens? Shit. Straighten this out. What happens? The market pushes into here, does not break this. Your first break, although one of the things I would come to learn about this is just because it looks so pretty like this doesn't mean they will allow you to have a stop loss that's this tight. So yeah, that's one of the reasons I left it at the time. But then that's not the point though. The point is you could have entered here, you could have your stop there, you could have your stop there, or wherever deriv would allow you to place, and then just look at that. Let's come back again to the 4-hour chart. I just want to show you multiple examples. What do we have? Actually, where is this? Yeah. This is beautiful. This is a daily chart. What do you have here? This is a low. Now, it's not a swing low. I will grant you that. But if I go to something like a 12-hour chart or a 6-hour chart, we will see a low that got broken. All right? When this got broken, what did it leave behind? Let me grab this and unlock it. And then I'm going to drag that up here to mark our fair value gap. Okay, zooming in. Boom. And then I'm going to put this red candle, red vertical line here so we know exactly what we're going to look at, and then lock this in place. So this is a daily chart, right? Let me go down to the 15-minute and see what we might have found. This is a 15-minute chart. This is that fair value gap getting traded into. And if you try to take this based on a 1, 2, 3 swing and you got stopped out, it doesn't matter. You'll wait for another entry. Or you could have waited for an actual break, if that's up to you really. Or if you saw this wick, strong signal. But look at this, here. This candle breaks it. When it breaks it, what do you see? Do you see what I see? I'm sure you do. Let's grab my rectangle again. Come here, bro. Thanks. Fair value gap. Changing that to white, making that transparent. Look at that. Precision. I'm going to grab this vertical line once more and place it here, and then I'll take you down to the 1 minute. Let's go to the vertical line. This is where the market trades into it. This is a swing. It's weird because it's boom, you guys who trade indices, but 1, 2, 3, that's a swing that led to this move and then pushing on down. The market comes here and it's turned around like this, right? So now you have a range from here to here. 50%, what is this? This is an order block now. What happened? The market traded right up into it, boom, and did not go beyond. Your stop could have been here. And then off you go. Off you go, you're running, you're off and running. So, I'm all talked out today. I just want to say, if you are struggling, the whole thing is this. Number one, learn about liquidity. Come to my lives. I'm always here Mondays through Fridays now. Okay? Mondays through Thursdays dedicated to the chart. Friday, we talk about some really weird psychology, spiritual type shit. That's one. I talk about the same thing over and over. Okay? For free. For over an hour. If you don't understand liquidity, come and learn it here. Because number two, I am particular about simplifying things for you. I used to struggle with trading. I did not find profitability until year 9. This is my 10th year as a trader. I do not want you to experience the same bullshit. And it's not because I was necessarily stupid. I'm not claiming to be the smartest person in the world. But it was that I knew too many things. And sometimes that works against you. I knew too much. And I open my charts and I'm seeing all of these things. I'm seeing this imbalance and this inverted this and this that. And I understand the Malaysian SNR and the rally break. I'm tired. I have come to find you only need to strip down your trading. Those of you who know ICT, you're studying ICT, and you still have not found profitability. I promise you, it is because you're trying to do everything. You're trying to be everything everywhere all at once. And it's not quite sticking it like the movie. What you need to do is pick just a few things. So are you going to be the kind of trader who, once you identify a downtrend, you're just looking for highs to get rammed through and then you're looking to trade in the other direction? That would be you being an external to internal liquidity trader. Or are you the kind of trader who is looking for the liquidity that is inside of a range because you want to take that liquidity in the range and take it outside of the range? That would make you an internal to external liquidity trader. If you do not define yourself, you will be utterly lost. The charts, there's so much information on a single chart. And then you have so many different pairs to choose from. When you have too many choices, too many time frames, too many choices, too many pairs, you will be lost. Too many strategies, too many things you're looking for. You cannot be, even in real life, you cannot be everything to everyone. And there is no medal for trying to be. It is the equivalent, you trying to do everything and trade everything, to me is not any different from being a people pleaser in life. Everybody wants all kinds of things from you, and ultimately, at the end of the day, you're the one who's going to get the short end of the stick. You think people will appreciate you for that, for being such a doormat, but that's not how it works. It's the same thing with the markets. How you do anything is how you do everything. When you come to the charts, pick one thing. It helps if during the weekend or at the end of the day you've looked through the charts, you've seen the price action on the high time frame. Pick the most likely one for you and then map out your plan of action. And if the market doesn't hit the prices that you want them to, then it does not, and you do nothing. The market's always going to be there. There will always be another opportunity. You don't have to rush, and you don't need too many things. To be real with you, today I had a few other losses as well. One was on, I was looking at the S&P 500, and then the other was on, actually that wasn't a loss, that was a break-even trade on Euro NZD. It was doing very well, and then we turned around back to the downside. And at that point, I had to call myself to order because I was like, hey, you can't be preaching this thing about saying just pick one, just pick one. And now here you are looking at all of this shit. That's not the plan. So I went back to the drawing board and I went to my notes that I had made over the weekend. And I saw it and I was like, oh, wait, what the hell am I doing looking at all these other stuff? Because sometimes, let me tell you something, I'm human. Sometimes, even when you are really good at analyzing charts, your confidence, your overconfidence can be your downfall. Because the whole mindset I was coming to it with is, I'm fucking good, it doesn't matter. I could look at any chart, any point in time, and I will find a setup every time. And that is true on some days, but what about the days that it's not? And then I go act like that, and then I take trades, and then I lose shit. So you have to be mindful. Pick one. Stick with one thing. And then if it's not the thing, it's not the thing. If the thing didn't do what you had anticipated, then it didn't, and it's fine. Move on. Okay? You don't need too much. You don't need too much, honestly. You do not need too much. And you don't have to change your strategy either. If you are a break and retest type trader, you use trend lines, you use basic support and resistance. And I'm not a fan of people, especially, at least I can speak for the ICT camp, who like to make other people feel like crap because, they don't understand liquidity. I'm not a fan of that. I don't do that here. I won't condone that here. So, but just because you have a somewhat basic way of trading does not mean that your method sucks. It doesn't. You just need to add liquidity. That's why I titled this live, Just Add Liquidity. So if you add liquidity there and then you're using liquidity on a high time frame, then you go to your lower time frames and you're looking for whatever it is you usually use to trade. If it's a simple trend line break, if it's simple support and resistance, whatever. But now your trades are more likely to play out because you now know where you're coming from. Remember, you now know where you're coming from and where you're going to. And you now know there's enough room for you to make some money so that even if you lose a couple of trades here and there, you can make that back and then some. That's why this third question is important. And that's why we use high time frames and high range frames to find the liquidity. Okay? Yeah, there was one more thing I wanted to show you. So for those of you who are going to plan to be external to internal range liquidity traders, I would like to pull your attention to the range and Renko bar charts just one more time before we take off. One of the things you can do, once you have identified that the market is pushing in one direction, remember this is EUR-USD. We already saw on the high time frame, regular time frame chart that it was going to be pushing up. One of the things you could do is say, I'm not going to trade until I get, for me, this is what I call it. I call it an anti-bias bar, which is very simply put, a range bar or Renko bar. It could even be a regular candlestick, honestly, but I prefer this with a range. And you can see for obvious reasons. I'm waiting for a bar that closes in the opposite direction of the trend. And then I'm going to ask myself, now you've done this. This is a 10 pip range bar chart, mind you. So I'll lock it in place. Now you've done this. Note this line. I'm going to a lower time frame. 1 minute chart. And all I'm asking myself is, now that I'm here, I'm just waiting for a swing. Why am I not waiting for a break in market structure? Because it's a 10 pip range bar chart. The market, for me to abandon this setup, I would need it to move at least 6 pips against me. And even then, I may not abandon it if it had come here and it had formed like a swing formation. This is a fair value gap, so I might have seen that as, okay, that's my entry. Why am I saying this? If you come back to this chart, typically, if you have a valid, what I call anti-bias bar, the market typically will not break beyond whatever's the lowest low next to it. So in this case, look here. So I would know if the market's coming here, okay, I'm probably wrong about that. It's that straightforward. I prefer the ones that close powerfully, that don't have too much of a wick. But even if you had looked at this guy here, look at this one. Let me unlock this. Actually, I don't need that. I could just do this here. Look at this guy. I don't know if you remember this area. This is the same area where I took that trade. And by the way, what do you have here? This wicking above, what is this? A fair value gap. But that's besides the point. Look here. Why would we confidently take this? Because the move hasn't even happened yet. So why would we? Remember, it's not random. We went to the 4-hour chart first to start plotting. Look at this. So, okay, let's see how that plays out on a 1 minute. Taking you back over here. Take a look. Right. All I'm waiting for, swing formation. Oh, I got taken out? No problem. Here's another swing formation. Stop loss where? Just at the low of, what did I say? Candle 3, or if you want, the whole swing. For just what? 2.5 to maybe, yeah, just 2 to 2.5 pips. And then, what am I doing? Writing that shit. Again, I'll come again. Once you have identified the trend, you have identified your high time frame or range frame draw on liquidity, all you're doing is saying to yourself, I'm going to wait for a range bar or a Renko bar or regular candlestick. I don't like regular candlesticks. There's a reason that I use Rangers or Renkos for this particular this kind of entry. I'm waiting for that. I'm going to wait for a swing, and then I'm going to take it. And then I said I was going to do one last thing. What was it? This is your boom indices again. God, I hate this chart. Not a fan. Look. Break of structure, fair value gap. Order block. Did not retrace into it, but what did you have here? The market retraces like this. This is a high, this is a low. This is 50% below 50%. Okay, you could enter and have your stop loss here. Then it takes off. What do we have? God damn it, stop that. Dragging this down. Breaks 50% of the range. This is a low, this is a high. Okay, swing low, swing high. It's a weird one, but it still counts. Discount, buy. This gets broken. Once this gets broken, what is this? This is an order block and they're consecutive candles. Okay, so maybe enter here, have your stop here. Or maybe as this candle forms, you now know you have a range. Wait for it to come to the 50% point. Entry, stop loss, go. And on and on and on. Okay? On and on it goes. Okay, so that's about it for tonight. I'm all talked out. If you missed the live, it will be uploaded to my YouTube channel in a few hours, probably if I don't sleep off or something. But that's about it. So now I'm going to go through the comments. Excuse me for a minute. Boy, so tired. Thank you for being here. Thank you for your attention. Thank you for your follows. Thank you for the likes. I see you. Thank you for consistently showing up. Because I love to teach. So you're actually giving to me as much as I'm giving to you. Thank you for being here tomorrow as well. I'm always here from Mondays through Fridays from 11 p.m. Nigerian time, West African time, which is UTC +1. We do not have daylight saving, so it's always 11 p.m. here. You don't have to worry about that. Just convert it to whatever time zone you're in. My name is Nessa. I take ticks on TikTok. I have started to notice copycats, and I want to tell you this. I will never ever message you first. If I ever message you first, then that's not me. You can find in my bio the link to my Telegram, where it's a free group. We all share, we connect with one another. In the Telegram, you will find information about mentorship. I only have 5 slots. And I think someone's about to pay like tomorrow or some shit. I don't know. we'll find out. I only have so much power, so much time. I offer myself here freely for over an hour for these 5 days of the week. So the time that is not free is not free. I do not have a problem charging you with that. However, I will not be the one chasing you and asking you to join me. That is not my style. I do not offer signals because I am particular about helping you develop yourself, your confidence as a trader. And if I give you signals, I would be robbing you of the opportunity to be certain of who you are and your abilities. I will not do that. I see it as wickedness, but if you want to go ahead and patronize signal providers, be my guest. The information that I provide here is more than sufficient for you to use to find your own signals for yourself every day in every market condition. You do not need a signal provider. If you insist on using signal providers, you can at least use the information that I teach you to help you vet what they're telling you and stay out of the losing trades. What else is there to say? If you are going to message me on TikTok, don't say hi, don't say hey. Send me your trading related question. If it's not a trading related question, I will not answer. If you're complimenting me, I will not answer. It's not because I'm not aware of the things that it is you're complimenting me about. It's because this is strictly about trading. I would like to keep things professional. What else is there to say? The mentorship is not necessary, it's not required, but it can help you. However, if you keep showing up for the lives, it could be all you need. I promise you. If you keep showing up for the lives, free lives, and you keep applying what you learn, you'll be good. I don't like people who swallow everything hook, line, and sinker. I love me a skeptic. I like when people doubt. But better than the doubters, better than skeptics are people who go and check what I'm saying just to be sure. I want you to actually try and prove me wrong. Go and check your charts, look at your charts. That's what I want you to do. Even if your goal is to prove me wrong at first, that's fine, because all I'm trying to get you to do is see that these things happen enough times for you to take advantage of them. I said enough times, not all the time, which means sometimes you will see a setup and it will fail. I need you to understand, if you are a newbie, there is no such thing as a holy grail. So you cannot see one order block or the very first fair value gap of your life, try it, and then it fails for that one trade, and then come and tell me this thing doesn't work. That's like going to the gym. You worked out for all of about that one day, then you go home and you start trying to flex invisible muscles in the mirror. Houseway, it's not going to happen. You need time. You need consistency. You need practice. For those of you who want to practice and backtest with this, you can check out soft4fx.com. Let me see if I have that website pulled up. One moment. Yes, soft, S-O-F-T, 4, number 4, fx.com. So they have a free version, which allows you to have 2 sample years of data, okay? But only 5 trades per simulation. You can't save or anything. If you want to pay for it and you have the money to pay for it, go ahead. But the paid version is a little bit pricey, and I got it when it was a little cheaper. But that's the one I know, that's the one I've been using this whole time. Again, SOFT number 4 FX, soft4fx.com. Okay? What else is there? Those of you who are absolutely brand new to trading, you want to start, go to babypips.com, BABYPIPS.com. If you were expecting beginner stuff from me, I apologize. In the beginning, I thought that was what I wanted to do, but I'm realizing that the traders I am here for are those who are still struggling after having mastered the basics and maybe even more advanced strategies. Another website you can go to is Learn to Trade the Market, not markets, market singular, .com/forex hyphen university. Again, learn to trade the market.com/forex hyphen university. It's an excellent website by Niall Fuller. Really wonderful resource. You should check it out. When you've learned the basics, and I'm giving these websites because it's a lovely way to vet. A lot of you message me and say you want to learn how to trade from scratch. I'm not here for you. I'm sorry. I will be here for you when you have learned the basics, because there's quite a fair bit to master, and that weeds out the people who are serious from the unserious ones. So go to these websites, check it out. Then you can start coming to the lives. What else have I neglected to mention? Yeah, okay, that's pretty much it. That's pretty much it. And now I'm going to check out your messages, see what's going on. Thank you for the follows. Thank you for the likes. Thank you for your time. Telegram link is in the bio. YouTube link is in the bio as well. Granula, you're very welcome. Thank you. Arsene, thank you. DOS, so there you go. YouTube link is in the bio. Arsene, thank you so much for typing this out. Olatia, I appreciate you too. Thank you. Oh shit, guys, thank God you're here. There was one more thing I almost forgot. I need to show you. Hang on. Don't go anywhere. Let's flip that. There's one more thing I need to show you really quickly. Because I just showed you a Renko chart and how to. This is in particular, it pertains to those pairs that move a lot. I'm going to show you guys how to take advantage of them really quickly. For those of you who stuck around, lucky you. I knew I was forgetting something. I want to take you to this is Euro NZD. I'm taking you now to a 20 pip Renko chart. Hang on a second. Where is it? All right, there we go. Let me make this easier to see. Okay, cool. Hey, whoa, what was that trade I got took out in? Anyway, somewhere around here. I need you to see this. It's still the same thing we've been talking about. Don't worry, it's nothing like too special, but I just want you to start considering those pairs that move a lot. Just find a range that works for you. Those of you who would like to be in and out of trades and done for the day as quickly as you can, this is for you. Ideally, I would rather that you looked at the high time frames first before you start assuming whether the market's going to go up or down. But because I'm trying to do this quickly and get done. So this has closed. We're now looking from this point here. Let me take you down. Excuse me. So a 1 minute chart. Come on. So life is simple. All you're doing is just looking for. Now, you remember these bricks, they've already gone bullish, right? So when it starts to pull back, all you're doing is waiting for highs to break. This breaks here. This is a fair value gap that is created, and then the market trades into it. Your stop loss would be now, depending on, because this is Euro NZD, some brokers have stupid spreads. I'm dealing with funding pips now. I don't like their spreads at all when it comes to this pair. But let's say you have something tight, like with IC markets here. Stop loss at the low here for about 3 or something pips. And notice how much you can easily get 1 to 10s with these, okay? That's all I wanted to show you. So once this creates a new Renko bar chart, you could just say to yourself, you're going to wait for some sort of retracement. You can look at these closes and opens, pick one as an area of liquidity. What do you have here? You have this pushing down here, which is great. And then what? Eventually, you start to notice the market pushing higher. This low is broken. Once it's broken, what happens? This is an order block. Stop loss here for about 2 or 3 pips, and you can ride that. Okay? When it comes back here again, remember I said just pick the open, close, or whatever. Comes back here again, you have this, it breaks to the top side. What is this fair value gap? Enter. Okay? It's excellent if you want to scalp or anything of the sort. Okay, that's all I wanted to show you. As you can see, if I marked more of these, you'd see more and more entries. This is a 1 minute chart. For those of you who have a broker that will allow you to scalp this, it's excellent with a tight spread, okay? All right, let me flip it around. I just wanted to point that out. Williams 4X, I appreciate you. Prof. Sammy, thank you. I see you. Bookie, thank you for the follow. Sir Lord, you're very welcome. You want to really add liquidity to your trading and learn this. Marco, absolutely. Please do that. Do that. Remember, it's not a strategy. It's just a story about price. Liquidity is a story of price. How it moves, why it moves, where it moves. Olati, thank you. Tobani, thank you for the follow. People support, thank you for the follow. Yellow Elephant, I see you. Hussein, recording will be on my YouTube later. Kuda Dingan, you're very welcome. Daniela, you're welcome as well. Let's see what else I missed. If you have your questions, now's a good time to ask. I'm about to leave. I'm just looking at the comments for now. Habiba, yes, my dear, doesn't matter. Any pair can be a good pair. Facts. Facts. I just hope many can understand this part of the teaching. So much willpower and so much attention to give a thing. Freddie Black, yeah, absolutely. I agree with you. She isn't either. She's just using it for educational purposes. Ma'am, can you change the color tool area near the camera icon? J8, if you're still here, color at the tool area near the camera icon. Explain. I don't know. This live thing is new to me. Dollar Bill, thanks for the follow. Which instrument is this? Let me see something. Give me a second. I need to see who's. What is this? Musa, thank you for the follow. Okay. Sorry, guys. Just scrolling back. All right. That's about it. Let me see what's happening here. Prop firms good and reliable. Well, I'll be honest with you. I think that they're a tool to be taken advantage of. I don't want to vouch for anyone. FTMO has been around a while. I can say that much for them, but that doesn't mean anything because at any point in time, anything could happen. Like with, I used my Forex funds, I used True Forex funds, and you guys know exactly what happened with those guys before. I was just able to recover my accounts. I actually bought 3 accounts from them, and the next thing I knew, it hit me with that message. Fortunately, I was able to recover my money. Okay, I think that's about it. Okay, people. So if you like the live, thank you very much. Thank you for being here. I'll be here again tomorrow, 11 p.m. UTC +1. May the markets favor you. Remember to be snobs. We don't take everything we see. What was the guy's name again from the inner trading circle? Michael Huddleston, I think. Or is it Hiddleston? Give me a sec. It is Michael, though. Michael. Oh, hell no. ICT. Michael J. Huddleston, yeah. Prop from a real account, which is good to purchase. That depends on you. Prop firms are typically for people who are looking for capital that they cannot afford to fund their accounts with in real life. So the way the prop firm works is you pay a fraction, a really, really small fraction of the actual cost. So for instance, you want to get a 100K instant account, and this is not a recommendation. You might pay like about maybe $500. There will be rules. You must read the terms and conditions or you could lose the account. With a personal account, there are no rules, but hopefully you have personal rules so you don't lose your money. Combos, zero pressure with real account because no rules. Yeah, true. With a personal account, there's no rules. If you are new or you have not been serious about restricting yourself, that might like be the one advantage of using a prop firm, is that you're forced to follow rules and to lean into being patient. Rip, you're very welcome. See you tomorrow. The 5%ers, I don't know, can't vouch for them. I hear good stuff though. Wall Street, thank you for the follow. Do we just search Nessa on YouTube? Rogue Introvert. I'm so sorry. I'm just seeing a message. The link is in my bio. It's in my bio right now. So just go from the live straight now, tap on my profile because I see that people are impersonating me. So just tap on and then click on the link there. Thanks for the follows. All right, I'm gonna call it a night, guys. Thanks for the likes. Thanks for the follows. Tomorrow's a new day, or rather, today is a new day. When is our next broken English teaching? Oh, let's see. My problem is how many of you actually want that? I don't think there's a lot of people that want that. That's why I haven't done it since that last time. Maybe I'll do a poll or something. For those of you who want to learn in broken English, okay, airdrops daily combo, okay, noted. I don't know. I wish I could set a poll or something on here. I'm just wondering. Aris love too as well. Okay, perfect, perfect. So there are people. How many of you want to learn to trade? You want me to teach? Okay, so for you, it's just that it's fun. Not voila. I'll think about it. I don't typically speak broken, not because I have anything against it, no. But like, I go run 'em. Aris Love, go to babypips.com. Let me just type that. I type that real quick. Babypips.com / learn. Aris Love, that's the site you go to. You can go there. That's weird. Can't pin it. Okay, no problem. So go to that site there. I wonder how you're able to combine the two. I'm super proud of you. Thank you. Grand Mula, catch you tomorrow. Guys, I'm actually going to click off now. I think that's about it for me. May the pips be with you. Don't do stupid shit tomorrow. Be a snob. And remember, you are already a trading master, and I will continue to hold that vision for you until you can see it for yourself. May the markets favor you. Good night.